The following is a presentation of TFNN. It is now time for the Diagnostic Trading Hour with your host, Darrell Martin.
And I got Lou from Fairfield, Connecticut, man. How you doing, Lou?
I'm doing good, Darrell. And I got to tell you, you're not just blowing hot air out there. I think the way you look at the market is terrific. You're a nice guy as far as over the TV. All the research you do, all the homework you do, I truly appreciate it. I appreciate your view of the market. It's awesome.
I appreciate that. Thank you very much.
Call now, toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, Darrell Martin.
All right, folks, we'll come on back here to the Diagnostic Trading Hour. We got the S&P right now, and we'll go ahead and just do a little, mid-time lunch market wrap for you. We had the S&P is currently down just a 1.5, pretty quiet right there. Most of them fell on down, popped on back up to their settlement price. And we've been watching that ever since this morning on the Bull Bear Binary Hour. Had up the S&P and just waiting on a close, and it looks like we might be getting it, but we're not getting that volume we were hoping for. It still may trickle on down with low volume, but I've been waiting on a close to close. This is the trade me and Tommy were looking at. A close below 1948.5. So we haven't got it yet. I mean, it's came below it, but it hadn't closed below it. This might be the 10 minutes where it happens. And so we're very close. We're right on the line. And 1947.5 was the low right there. That was the bar that basically triggered it. We had increasing volume, pushing on up, and it was right after a gap fill, but no bar is going to close below the low of that bar. And what I was hoping to see was a bar not only close below the low of this bar, but also see some volume picking up. Ideally, more volume than that right there. So we'll see what happens. It looks like it is going to finally close down, and it needs to move about one more tick. But if it doesn't, then what's going to happen is this part's going to keep oscillating back up, and we got a magnet going on right here, right at settlement from yesterday at 1948.75. And again, that was a gap fill. If you don't know what a gap fill is, it is. I'll back up on the chart for you. It's where the market closes. So, put right over here, market closes, and 1948.75 was basically the closing price right there. And try to zoom in, make it a little more visible. But let's see if I can do something that's easier. There we go. So you can see. So the market settles right there, but then the market opens over here at about 9:30. Okay, we have the market open right here. So there's a gap, a difference between where the market closed and where the market opened. And so if we measure, what was that gap? Closed to open. About 3.5, little, almost 4 points. And it is breaking down now. We are actually starting to get some volume that's at least increasing past the previous bar. So we're getting a little bit of strength to this. And I would like to see more, but I think we're going to have to go ahead and go for it. So let's see what we got. If you're looking over at the S&P, hopefully you already have your stuff set up from this morning that we put in there. You can use 3 or 415. Your lower risk contract is even another 415. That's actually really probably a better choice. All right, so the best contract I see if you want to take the short now, or to be right over here, would be actually the 1910 to 1950. We get a little wider contract just in case there is a big move. But it's a better choice than the 415 simply because you're only giving up like 2 more ticks, which on Nadex is less than 1 tick on a yes because it ticks in dimes. Let me show you where I got the idea on this contract from. So what I have up here is I have sell. I have basically plus or minus 20, a 1-to-1 risk-reward ratio. Okay, and I got ES selected. And so if I go here and look at the S&P, then I get a few choices. And I got 3, and I have 415 and another 415. I also said I want contracts that expire with I want more than an hour till expiration. I could get rid of that if I wanted to. But, we can make that like 0 right now to get current hour. and see what's in there. That might give us like one more choice. So we got a 2 o'clock, a 3 o'clock, and as far as low risk, no stop loss, a 415. And the 2 o'clock's risking 30, the 3 o'clock's risking 35, the 415's risking 38. So as far as the risk, there's really not a massive difference right there. And you get more time, obviously, with the 415. You get more time with the 3 than you do with the 2. So for $5 more, if I'd have another hour. For $3 more, I'd have another hour and 15 minutes. So for basically $8 more, I can have 2 hours and 15 minutes more. Then, yeah, I'm probably going to go ahead and go with that. The other thing that I'd be looking at is the break-even distance. And it can be a little tricky because 10 sounds like a lot, but that's not why, again, the S&P ticks in quarters. The US 500 on Nadex ticks in dimes. So 10 ticks on Nadex is 4 ticks on the S&P. So when I see 10 ticks, I got to transmit that in my head to 4 ticks on the S. 13 ticks, 5 ticks on the S. That's a point, a point and a quarter. That's really not a big deal. So I'm not worried about that premium in there. That's not overpriced premium. It's not costing too much. And so out of all those choices, I'm going to go, you know what? If I got to give up another tick, really it's not even a whole tick right here between the two of them, right? So there's $2 between the 3 o'clock and the 415, and it's not even a whole tick difference in pricing. Yeah, I'm hands down, I'm going with the 415 at this point. So I get the most amount of time. I only take $3 more of risk, and I don't even take a whole additional tick right there. But like I said, we still want to see that increasing volume. So we gotta find that contract before the trade comes up. So when I see it start happening, I'm like, all right, looks like it might be closing down. I'll pull it up. Didn't do it. Closing down, but that closed below. Let's find a contract. Where's the volume? We don't have the volume yet. Okay. So I'm watching for volume right now still. I got it up. If I go short, then I'll go in. You can go 1, you can go 10, you can go 20, whatever works best for you. 50. So, but anyway, so that's the one I got picked out that I'm selecting there. Somebody looks like they're trying to get out of it, 1949.4. They're going to have a difficult time on that. Anyways, so our stop loss is up here at 1950. And meaning that's the ceiling. So if you're not familiar with Nadex, every contract has defined risk. Think of this like as a call or a put option, but for day traders. Okay, and it's pretty sweet as far as the pricing. When I say call or put option, that's not like totally it's not being misguiding. Like that's literally how it works. Okay, there is a cap, so that I would say that's the difference. Like if it goes down to 1910, it stops making money. But you made 40 points. You're okay. So you can call that the difference. But you get these every single day. And I want to show you how accurate the pricing is. I mentioned this yesterday on the show briefly. And so what I'm going to do is I'm going to open up Thinkorswim. And what we're going to do is we're going to compare 5 S&P E-mini contracts. Okay? And we break below here. We made it be going. It's just having a hard time. Like I just don't want to get stuck in this little oscillation zone. So I'm trying to avoid that. So we get that price level. See right here? This is our first price level. Here's our second price level. So I might be willing to go ahead and go with it if we have the second price level without the volume right here. So that's the last point where the market filled in. That's an easy couple points. We might get more than that. All right, there we go. We're going. Okay. Volume's picking up. And we're in. Okay. So we got our trade on set up. Now let's compare this over here to the S&P. So while this trade's in progress. And we get it. I'm going to pull everything up for you. So to make it easy. Yeah, she's dropping now. See how that volume's rising, and it's right after we broke that price level. So I was like, let's grab it. Okay. So I want to see if I can find a contract. Call put type contract. Let's see. We sold the 1950. Okay. And we pull this window out I have on the other screen. There we go. And I just want to revert this back over so you can see the pricing. All right, so what we're going to look at over here is we're going to check out the 1950 put because we're selling. And the ceiling of this contract is 1950. So we're going to line up the strikes. We're going to line up the expiration date and time so both expire today at 4:15. So we put in a buy. We do just one simple contract, okay? So we got one on there. One put on the S&P is 50 options. One contract is 50 options. And it's not like stocks, they're all 100, but futures are a little bit different. Well, 50 options gives it basically the point value of $50 a point, like the S&P has. Well, if we go on over and we look at Nadex, it's $10 a point, right? So 10 ticks in a point because it ticks in dimes. There she goes. Come on. Anyways, and basically the way that Nadex prices is they price in the strike plus the risk, okay? So if we go down here and we're looking at this contract and you bring it up, just doing a demo here for you so you can see the difference, okay? Make sure I have the right amount on there. If I can get all this lined up. I'm trying to get it all on one simple screen. Let's see here. Okay, so we have one put. It's expiring today for the 1950 contract. Current pricing of $6.50. Okay, and then we put it on, just matching them up, 650, 650, yep. Then we get a cost of, on Nadex, a 1950 put a sell on the spread, okay, is costing right now 1943.6. That's $320 for 5 of them, okay? So your risk is $320 on CME. To buy a 1950 put that expires today at 4:15 is $325. Okay, so pretty simple. Basically the idea here is just to show you how they line up. Okay, so when we get back from this break, I'll go, well, why would you trade Nadex then if it's the same on S&P? It's the same on CME. We'll talk about that when we get back. Stay right there.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock in option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
Investors, Taz Market Research delivers to its subscribers expert commentary on the analysis of 50 different markets each day. Get this invaluable and timely information through the daily market research videos Taz Market Research produces each day before 9 a.m. The video analysis will include reports on currencies, interest rates, indices, metals, energies, grains, and more. You'll be able to gauge where high profitability setups are in each of the markets. Receive a free 2-week trial subscription to Taz Market Research videos on the front page of TFNN.com.
The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN, and you'll find The Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now.
With the launch of Tiger TV, TFNN has brought our programming to the next level. With Tiger TV, you can gain access to each host's charts and computer screens as they host their daily stock program. Whether it's Tom O'Brien, Steve Rose, Basil Chapman, David White, Larry Pezzavento, Andy Hecht, Victor Jones, or Darrell Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV, then visit TFNN.com and see what you're missing. Darrell takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
All right, so here's the Diagnostic Trading Hour. Okay, so what we're doing is we're looking at this, we're comparing the CME, E-mini, ES options to the Nadex spread options. And going, why would you do one over the other? Okay? Well, as you can see, the risk is basically the same. I mean, Nadex may be a few dollars cheaper. CME may be a few dollars cheaper. You know, just depending upon the second that you click on the button. All right? So the last few clicks that we've done here, the Nadex has actually been about $10 cheaper on 5 contracts. So about $2 a contract cheaper. So not bad at all. And then, you know, so that would be one reason, but I've seen it go both ways. It sort of depends upon the market at the moment. If we look at a few other factors, let's see. We got I'm trying to calculate in here. Let me do one calculation for you real quick. Okay, so another calculation. Let me do a screenshot. It'll be easier if I capture this thing real quick to try to do this. Right there. Okay. If we look over here, we got basically a 75-cent bid-ask spread on S&P E-minis, right? So that 550 to 625. And so with that bid-ask spread times 50, so you have a $37.50 bid-ask spread on the CME S&P E-mini options. Okay? Now if we go over here to Nadex, we got 1944.5 minus 1944.1. That is 4.4. Okay? And which is really small. We're going to do, and it's at $4 a tick, and we're going to do 5 ticks. So that's $20. So we have a bid-ask spread of $20 on Nadex. So not only are you getting it the entire contract, we saw that we were saving some money on right there, right? But we're also, so we saved, what was that? $7.50 on the contract, like less risk, and you're also saving $17.50 on the bid-ask spread. That's why I love it when people come and they're like, how do you get over the massive bid-ask spreads? And I'm like, it's an option. It's an option, buddy. Options are different. So you have defined risk, less risk. Obviously, a little lower liquidity. Somebody's making a market. They're taking that risk on. Okay. So we have a tighter bid-ask spread than the CME options. So, and we have a cheaper price than the CME options. Both of those things are benefits. What else would make it worth doing? Well, we go in here. I can do one. I can risk $61. I don't have to risk $312. So I can risk less money. I don't have, like, I can only do one CME E-mini option. I can't do 1/5 of one. Okay? On Nadex, I can do one, which is equal to 1/5 of a CME S&P option. Well, maybe you're like, well, I don't trade that small anyway, so it doesn't matter to me. Okay, but fine. You probably, hopefully, have a good risk management plan. And maybe it's a defined percent risk. Well, here is, you can go from 312.50 to, you can go to 625. Or you can go to, 936. All right, 937.50, I guess. Like, you're going to jump $312 at a time. You can't go, all right, well, I'm willing to risk $400 a trade and go, okay, well, let's see, 6, 7. Okay, there we go. So I can either do 6 or 7. So 6 would be right at $366. That keeps me under my $400 risk. You can't maximize and really granularly go in and define your risk down to the percent within a few dollars. You have to either go 312 or double it. And it's addition versus compounding. Because, you can just literally, micro go in and just add a little bit at a time. So you can do 6, 7, 8, 9, 10. You can either do a whole one or a double of one. There's nothing smaller. So it lets you better manage your risk. What's the other thing? This pricing right here is what is available for what? For ones that expire today, Friday, 4/15. Well, if I go over on the CME, and let's see what's available, okay? Then what's going to happen is I got some other June contracts that are going to come up. We'll talk about this in a second. It's a really interesting thing when you start looking at it. I stay right there. We'll be right back after this.
In quiet markets, investors search for new trading opportunities. We'd like to introduce you to a new product that provides opportunities even in flat markets. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization capability. Nadex's unique short-term binary options allow traders and investors to capitalize on strategies even when the underlying markets are quiet. Nadex's innovation has allowed them to come up with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com, or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
Andy Heck's powerful weekly newsletter, the Technomental Commodity Report, has delivered multiple triple-digit winning trades in recent months. And right now's the perfect time to get a full month-long trial to Andy's newsletter with no obligation to pay anything. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Technomental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you'll lock in the low rate of only $59 a month. Sign up right now for the Technomental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com.
Darrell Martin coined the phrase diagnostic trading, and we're happy to announce that his Diagnostic Box Spread Analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Darrell Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads.
Who says you can't take it with you? TFNN says you can. With your mobile device and TFNN's live radio streams, TFNN has put it all in the palm of your hands. No special apps to download. No subscription fees for live radio or Tiger TV streams. We say you can.
Now let's go over to the dollar, because the dollar is going to be the generator. It is the generator of basically higher dollar, lower market. And what the dollar has done, and this whole uptrend, folks, has just gone sideways. The way it works, folks, is this.
We say you can. The Tiger Financial News Network. Smart investors and professional traders know you can. TFNN.com. Educating investors. This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
All right, still watching our ES trade over here. And just if you want some profit targets real quick, we got a couple levels that we got to break through. We got a couple profit targets we're going for. The first level we're going to have to break on through. I was going through, I was plotting some magnets, some old magnets as well. 1943.25, as you can see, that also has been a support level today, was a resistance level before broken through yesterday. So that is the next level we're going to have to break through to really hit our profit target. Once we break through that, there really is nothing in the way for us to get down to 1938.5. The thing I like about 1938.5 over here is twofold. One, it was the low of this high volume bar yesterday at 950. Basically a magnet bar within itself, which also became the negative 0.7 deviation level of the day. From there, we can actually go a little bit lower, and that would actually bring us down to 1936.25. So right over here, that being the low of the 10 a.m. bar yesterday. That was the exact price that Tommy was laying out based on that the low of the bar, based on the magnet spike down. And so basically, I was looking at basically both of those because a little bit more volume on the previous bar, and it was a down close, and it's today. So sort of that conservative, like once I hit that 1938.5, take off part of my position, may take a little bit more down to 1936.25, and but that's our two targets that we're going on for today by the end of the day at 4:15 Eastern Time. And right now we're just waiting on, the S&P came down. It broke that level that we were waiting on it to break. It broke down the next support level. Let's go and look at a little market analysis. We'll come back here in a second to CME versus Nadex spreads. But so we went here, and I was waiting on this level to be broke. It wasn't broke. We didn't get any volume on the down close. Finally got a down close, but it was on lower volume right here. And I was like, okay, so it came right down now to the next level. This is where price orders stop going down. And this is sort of that story you want to start learning to read inside bars and figuring out where orders are at. So like right here, we can see the low of this bar. See how that low is hit over and over and over again. So in this bar, this is where they decided to not fill any more orders below it and just go up. And they keep coming back down to that level. Again, but not closing below it. That's why we're looking for a close below. We finally got a close below, but there was really no commitment, no volume. And I'm like, okay, well, what is the next level that we haven't closed below yet where we had some volume? And I look over here, and I'm like, oh, there's a little bit of decline in volume, but it's still about the same as, the level we were looking at before. And this is where the market came open, it closed down, stopped filling orders to the downside, or not closed down, sorry, went down, stopped filling orders to the downside, and then moved on back up and start going from there. So I'm like, okay, if we break this level now, I know we're not getting the volume, but if we break this, we're probably going to jump on down to here or here, and maybe down to this level down here. And so we start breaking it. I start seeing volume kicking. I'm like, okay, let's go now. Boom, we hit the order. It happened in the last segment right there, went short. Market's moving on down, 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 and doesn't quite hit this next level, 1943. That's sort of our little barrier that we got to get through. If we don't, we may oscillate back up. Right now, we are oscillating a little bit. We had a massive, that volume came down really strong like we wanted it to. The volume we were shooting for, let's see if we got that. We were shooting for a volume of around 30,500. What do we get on it? We got 36,000. So we actually did exceed the volume that we were wanting to hit. So that's really good. So we hit our volume. We did break below our low. We got our close below. We had to jump in a little earlier because if we waited on that volume to hit it, would have been too late. Now, we did have a volume spike, okay, which usually is followed up with a retracement for a couple bars. So here's check out this volume spike, okay, compared to the previous volumes. And I just mean a spike in volume. But volume jumps on up, and, we got one more little up bar, and then it pulled back for a couple bars, and it took a little while for it to continue on up. And we got, another, couple points out of that. So let's see if we can get a few more points. And dropped on down. Not surprised to see it retrace. Right now we got about a 50% retracement on this little down move from this bar. And so, expect it to start turning back on around. The question is, can it break through 1943 with some volume? If it can, then that's where we're going to be able to go in and really shoot down to 1938.5, maybe even 1936.25 down here. And, capture us a nice, nice profit back up from the entry of around 1947. And it'd be nice to grab about, 10 points or so on that trade. So, anyways, we got it rolling, and just got to sit back, let us do its thing. One thing you don't hear me talking about right now is a stop loss. So, why? Because I'm trading the Nadex spreads, and depending upon what spread you choose. Okay, now all of them have capped risk, but that doesn't mean you want to take on the full risk. So, depending upon what the risk is in the trade, on this one I'm perfectly fine with the trade we got on. I don't need a stop loss. Okay, because the trade is my stop. It can go against me. Whatever, it can come back. I'm comfortable with the risk I took on the trade, the max risk on the trade. And if you're comfortable with that, if you can find a spread that does match an acceptable risk to you, then you don't need to worry about a stop loss. And the beautiful thing about that is you just sit back and basically you can set your profit targets. So, go in and put a take profit to go in and go, okay, I want to buy back when it hits 1938.5. Maybe add a point to that just for a bid-ask spread or variance and an option, so maybe 1939.5. And if you want to go for the second profit target, then we got 1933, 1936, whatever, 0.25 down here. So maybe put that at 1937.25, and put half and half. If you only have one contract, you probably that's one of the things that I know I've heard Larry talk about is if you really want to start making money in trading, you have to start doing more than one contract, because otherwise you can't layer out of a trade. you're always going to have to take that first big. You're always going to take that first profit because you got to be conservative because you don't want your winners turning into losers. Why is that a problem for you? Well, because you can never let your profits run. So you get to a certain point, and you're like, I just can't let this go away. And so you've got to close out your entire position because you have a position of 1. And that brings us back onto the topic I was talking about a second ago, where we were looking at Thinkorswim. And on Thinkorswim, we were looking at this, and we were talking about this trade and how you can only do 1 option at a time. And that's going to be 50 options, right? So let's say you are okay with doing just 1. And we pull this up here. We pull it back up. So let's just say for a moment that you're comfortable with doing, you're like, I can do that. Well, the other thing you may or may not have considered, I'm not sure, is the fact that you got to get out of it, the entire thing. You can't get out of half of your S&P E-mini CME option. So if you want to layer out, you got to do more than 1, which means you can't just risk, $300, in this case $350 right now on this contract. You'd have to risk, actually I might be on a later expiration. I might be on the end of month expiration. Let's go down here, so we're at up here. So right now it's 50, so about $250. So about $250 risk on the trade, or you got to do $500 risk, so you can layer out. Whereas on Nadex, you could do 5, you could do 10, you could do 6, you could do 8, whatever. And so you could get out of half your position or a quarter of your position or, whatever, and allow the other half or quarter, whatever, to run on your trade and, maybe scale out. You could scale out. Maybe you did 10 contracts. You could scale out 2 at a time as it's moving down. I mean, there's a lot of different methods you can use, but you're a lot more able to do that because, 10 contracts on Nadex would be like 2 ES spreads. I mean, there's, plenty of combinations in there on scaling out of a trade. Or scaling into a trade. If it's moving, you're okay, I'll get into 5. Okay, I just broke this level. Now I'll get into 5 more. Now I'll get into 10 more. Now maybe I'll just add on 2 more. Whatever it is. Like right now we're waiting on it to break this level down here, right? That's 1943. And if it breaks it with volume, we expect it to move on down pretty quickly to 1938. You might go in there and you might have a stop order to go and hop in and go short. Should it, you have to use like a stop trigger that we offer. But to go in and go short, should it break down below 1943. And so if it does that, you can go and go, hey, I'll hop in that trade because I think I'll be able to write it down for 5 more points. And, maybe you'll add on 5 more, maybe you'll add on 10 more, maybe you'll add on 1 more, maybe you'll add on 2 more. But you don't have to double your risk from, 1 contract to 2 contracts, and just keep, amplifying it even more and more and more. You can really fine-tune that risk. That's probably one of my favorite pieces. Now, another couple other benefits here is you basically have 3 different kinds of contracts expirations on CME. You got your weekly contracts where they expire every Friday. You have your end of month contracts, which is what they sound like, expires at the end of the month. Then you got just your the Friday expiration. So that comes up every month. You don't have expirations every day. You don't have expirations every hour. On Nadex, let's just say the S&P, you have expirations at 10 a.m., 11 a.m., 12 a.m., 1 a.m., 2 a.m., or no, not 10 a.m., 10 a.m., 11 a.m., 12 p.m., 1 p.m., 2 p.m., 3 p.m., 4 p.m., and 4:15 p.m. And you have the dailies every day that start at 6 p.m. and go to 4:15. So I got intraday expirations, and I got daily expirations every single day. What does that mean? Why is that important? Well, what you do to see why that's important, let's go over here and let's look at our Greeks, because that's going to show you why it's important. And then let's just shrink this down so you can see a few more dates at once. Let's get rid of the order. Okay, so just to give you an idea of what's going on, and usually we don't have the end of month except for like right now. Okay, so let's look at what's normally out there for you, from week to week to week. So comparing this contract to today, this can expire today, which we saw was very similar to Nadex. Nadex actually was better on bid-ask spread. It was better on pricing by, like $5. Bid-ask spread by about $12. So, you're keeping about $20 in your pocket on the trade there. But just comparing them, apples to apples and looking at them, we got, let's look at this. And what do we get for our money? Not only do we pay less, but right here you're going to go in and the same expiration, let's see, 1950 put, 1950 put. You're going to put twice the amount of money on the trade. Okay? So I'm going to put up $11.25 to be able to do, like if I want to do a contract that expires next Friday. So I got to put up a lot more money on this. I'm actually surprised it's that low. Usually it's a lot higher. So yeah, that's actually a little better than usual. But anyway, so right now it's $11.25, but still you have to put up twice the amount of money just to do one. And then we go over here and we look at our deltas. I mean, I would expect those to be pretty close, but we're talking a delta of 81 versus 58 right now. Okay, so you're getting a lot lower delta. Like, so doing a Friday delta, you're getting 81 or negative 81. Okay, but doing next Friday's delta, you're getting a negative 58, which means your price is only going to change like 58 cents for every dollar movement on the S&P versus 81 cents for every dollar movement on the S&P, at least for the next, so many points. So therefore, the price moves faster and you risk less money. Okay? And then we go over here, we got, what about our gamma? Well, that 82 is going to go to 92, like you said, pretty quick there, because look at the gamma. The gamma is 0.05. So it's going to be adding every point. It's going to be adding more and more and more until it gets it to 91 and then 101. And so if I expand this out a little further, the market would have to move 15 points, basically, to equalize the delta value I'm getting. And if you don't get delta, if the S&P moves, let's say it makes $50, okay, and I have an 80 delta, then I make, what would that be? 8 times 5. I make $40, okay? So basically, I'll make $40 on a $50 move. Down here, I would make about $28 or so on a $50 move. So I'm making more money because it's an option, so it has a speed of change. That's the delta, the speed that the price changes of the option versus the price change of the future. Okay? So right there I get a better change and better rate of change of speed for less risk. And let's see here. Your theta is going to go up, but there's a lot less of it, so it doesn't matter. And Vega is going to be lower. That's because implied volatility is higher as you get closer to expiration. Vega actually impacts options more the closer and closer and closer you get to the expiration of the contract. Let's look on over here. And look at that there. Options just like they know I'm showing their prices. But let's see. Like, where did all their deltas go? And the next thing we get, they just dropped all their quotes. Here we go. Got that. See if we reload. Okay, so we've shown how you get more delta with less time to expiration. We've shown the pricing. We've shown the risk. We've shown the better bid-ask spread. So there's a lot of benefits, and you get this every day. Okay? And even less because you get down to 2 hours before expiration. So less money, less risk, more buying power, more profit per point. Okay? All right, stay there. We'll be right back after this break.
You take a hands-on approach to managing your investment strategy. You're always looking for the next trading opportunity to magnify your perspective. Direction Shares connects sophisticated traders with a powerful array of ETFs from a wide range of asset classes. The markets may go up and down, and you want tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foreside Fund Services, LLC.
Hi, I'm Steve Rhodes, host of the Money Master Show at TFNN.com. Eastern legend tells of a fair maiden who was offered a rare gift by the king of the land, a bag of pearls. The king promised that she could keep the largest, most perfect pearl she could find with these 3 conditions. 1, choose only 1 pearl. 2, remove 1 pearl at a time, accept or reject it. And 3, if rejected, it would be lost forever. She began by looking at the pearls, passing on many special treasures. She delved deeper into the bag, and soon the pearls were replaced with pebbles. Sadly, she went home empty-handed. Folks, replace pearls with time, because we cannot go back even 2 seconds. We live in the eternal moment of now. So when now are you going to take advantage of my offer to you, a subscription to my daily investment newsletter service, Mastering Probability, where you can experience the most incredible pearls for trading and investing, the Rhodes Momentum Indicator and Strategy. The offer? It gets better. A 30-day money-back guarantee. Don't go home empty-handed. Mastering Probability. Available on the homepage of TFNN.com.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
Join David White as he keeps you up to date on the latest tech stocks while he uses his Power Law Vector Indicator to identify the best trades. The Power Trading Hour, next on TFNN.
All right, folks, come back here to the Diagnostic Trading Hour. And going through a few things for you here. I want to make sure. And let's see here. Hold on 1 second for me. There we go. Trying to just update something on the screen over here. Then we can go through it together. See if that may not come through. I was hoping it would. Okay. That ought to do that. All right, so we're seeing it oscillate right now. Getting stuck in a little oscillation zone. Got the last 2 hours. Usually get a lot more volume here in the last couple hours. We can actually see what kind of expected volume we should have coming on up. And just working on adding this feature in now, so pretty excited about that. Should be helpful. And it's like I hate it whenever stuff pops up like over in the corner window like that. Get a right click on it, get a quick move, and you can drag it from there. There we go. And on down. Okay. So expected volume, we'll get 10 minutes. We can see what kind of volume we got, coming up here for the rest of the day. We're at 150 right now, so let's scroll on down to that. That's going to put us right there. Okay. And see if we have that built in on the contracts. And our expected volume is about 17,000. So it's coming up. Trying to see if we have anything in there, but it looks like it's got just about everything but that final piece of information on it. Okay. So the format there is going to add a couple more pieces. All right. So we're basically oscillating right here between these 2 points. You can see like right there, it's going right back up to what was our entry price. So we're basically right back up to break even. And it's just oscillating right now between these 2 points. Like I said, the real barrier, we wanted to get in here so we got to show you some nice money if it moves on down. So it was a great entry price. But we're sort of stuck right there. It's just oscillating back. So what I'm hoping is it came back up to what was a very hard price for it to break through. As you notice how it hit it over and over and over again. Hoping that line that was a support now will become a solid resistance. If it does so, which would be true to fashion, if it does do that, then it comes on back down and we get to break through here. Hopefully by end of day, settle down a little bit of negative note on the S&P, and wrap it on up. So we'll see if we are able to move on down. I don't know if we're going to go all the way back down to yesterday's low. That's why I have that first settlement at 1938.5 on the negative 0.7 deviation level. And I think that's a little safer, closer, take profit zone. So depending upon how the market plays out the rest of the day, I may close out my entire position or part of my position. At least you're going to have part of that go ahead and set for a take profit. When it hits 1938.5, I'll monitor the rest of it. If I think it's just there's no real velocity happening on the way down there, then I'll just close the entire thing out. So just want to give you that plan so that way if we're not on the show, obviously we won't be on the show when it happens, you'll be okay, you'll be ready for that. And I want to say we don't have anything major, but I want to double check for our news plan coming up. Let's see, Sunday you have a new home sales report, and that was a tentative be aware, okay? And there's no time, and that's on the Aussie. So sometime on the Aussie that night, we don't have anything in the morning except for CAD does have GDP. So be aware of the CAD GDP 8:30 on Monday morning. That's going to be your one news report we really want to have your eyes on. The other one is the pending home sales at 10 a.m. on Monday morning. Make sure you also are aware of that. All right, y'all have a great day.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
You're watching Tiger TV.